Welcome to Personal Finance TV. Today we are going to discuss the biggest and the most sophisticated financial scams that ever happened, the global financial crisis of 2008.
The housing market collapse created one financial crisis after another.
The most significant financial crisis in the post-war period.
Soaring gas prices, falling home prices, and rising unemployment.
I'm Aditya Iyengar and I am a CFA charter holder, and today my responsibility is to make sure that you understand this entire fiasco in the simplest of words. Let's begin. If you want to understand why the stock markets crashed so badly in 2008, you need to first understand how the housing market worked back then and how this one particular product called a mortgage-backed security came into existence and how it led to the collapse of the entire system. Now don't run away when you hear such huge terminology. I will explain every single thing bit by bit in the simplest of words. Now if you are watching this video, you are very likely an investor in some or the other product. You invest in FDs, you invest in stocks, you invest in bonds, you invest in mutual funds. Now what if I asked you, would you like to invest in a home loan? Is it possible for you to do that? Look at Mumbai for example, where the average home costs north of 1 crore rupees. If you, the average retail investor, had to invest in a home loan, you would have to come up with 1 crore rupees first and then find a suitable borrower who would like to borrow this money from you. And even in this case, you are not at all diversified. You are just invested 1 crore rupees, which is very likely a huge sum of your total portfolio, into one such home loan. Now, if this one person defaults and doesn't pay you back, you lose the entire 1 crore rupees. You would then have to go out and try to sell that property, which would once again be a very tedious and difficult process. So if the retail investor wanted to invest in home loans, he could invest in mortgage-backed securities. These were government-sponsored entities and they defined something called a qualified mortgage. A qualified mortgage was simply a home loan made to a person who's very likely to repay it. That is a home loan with high credit quality. So as long as a bank made a qualified mortgage, number one, the interest rate was extremely low, and number two, it was very easy for banks to sell such a loan to an investment bank and for investors to buy those loans. When investors saw that this was a qualified mortgage, then they immediately invested in them because these came with an implicit government guarantee. Implicit government guarantee is not at all difficult to understand, especially if you look at it in the Indian context. In India, the Indian Railway Finance Corporation, IRFC, is a government-sponsored entity. Now, IRFC also issues bonds that retail investors can invest in. But just in case IRFC is unable to repay these bonds, the government of India steps in and makes these repayments. This is called a sovereign guarantee, and that is the reason IRFC's bonds are also always rated AAA. Now, before we understand what mortgage-backed securities are, you need to know two things. Number one, they made investing in home loans very easy for retail investors. And number two, the way they were created were where all the problem lied. Let's say there's a huge bank named ABC. This bank gave out 10,000 crore rupees worth of home loans to different people. Some people had absolutely great credit quality. They had a lot of money. They earned a very nice salary. Their jobs were stable, and they were buying great houses in prime locations. On the other hand, there were people whose loans were of average or poor credit quality. These people may not have had great jobs. These people had okay income, and the real estate that they were buying might have been average or below average in quality. But there was a problem. The bank only had 10,000 crore rupees to give out as loans. Now the bank also wanted to grow more. They also wanted more funds. So what did the bank do? ABC, which was a normal bank that served retail customers, they went to a much bigger investment bank and they sold these 10,000 crore rupees worth of loans to this bigger investment bank. Now you might wonder, why would the bank do that? If they gave out loans worth 10,000 crores and they just went to an investment bank to sell them these loans worth 10,000 crores, what's the point? There were two huge benefits of doing this. Number one, the bank didn't sell the loans for 10,000 crores to the investment bank. The bank also made money from fees, which was purely the bank's income. If 10,000 crore rupees worth of loans were given out, the banks also made money from processing fees, appraisal fees, transfer fees, and this was purely income for the bank. So let's say the total amount of 10,000 crores had 1,000 crore rupees worth of fees. So now the bank sold 9,000 crore rupees worth of loans to the bigger investment bank. So the bank made money. And the second biggest benefit was that for doing this transaction, the bank just got 9,000 crore rupees worth of fresh capital that it could use to give out more loans to more people. While doing this, the bank was also able to get all of these existing loans off its balance sheet. So even if these people defaulted, the liability didn't lie on the bank. This liability got transferred to the investment bank. Now here's the thing. The job of an investment bank is to facilitate extremely large capital market transactions. So why would it bother investing in home loans? Which is exactly what the investment bank did. The investment bank took a cut for itself and sold these loans to normal investors, small investors like you and me. To do this, the investment bank created a new company called a special purpose vehicle in India, and in the US a special purpose entity. They transferred all these loans to this new entity. And what this new entity did was to issue bonds backed by these home loans that were first owned by the bank and now are owned by the investment bank. These bonds were sold to retail investors like you and me, and as the homeowners paid their principal and interest on the home loan, the normal retail investors like you and me would get their principal and interest repayments back. This separate entity would issue bonds that were backed by these home loans, and these bonds were purchased by retail investors like you and me. They were also purchased by extremely large mutual funds and pension funds that handled money for smaller investors. So look at this cycle. The bank made loans and they earned fees from those loans. They simply sold those loans and got them off their balance sheet to the investment bank. Now the investment bank also sold these loans to investors. So what happened in this process? The bank made money, the investment bank made money, and the investors started bearing the risk for these home loans. Now that's not a bad thing as long as these home loans are actually of good quality. But don't you think that the people with high credit quality, great jobs, stable income, and who are buying houses in prime real estate are very few? Don't you think that eventually you would run out of such people to give out loans to? Now in the US, there were two entities, Fannie Mae and Freddie Mac. Now these government-sponsored entities would also buy all these home loans and issue bonds against it. And people had immense faith in these bonds because they came with a sovereign guarantee. This is called an implicit sovereign guarantee, which is why all of IRFC's bonds are always highly rated. A high credit rating means that these bonds are unlikely to default on their principal and interest repayments. More on this later. Now think of this logically. These qualified mortgages had a very strict criteria with respect to the type of borrower. In simple words, not everyone is very rich or very stable, right? There are always going to be a lot of people who are more likely to default. And if banks are in this infinite loop wherein banks are giving out loans, then the banks are selling these loans to investors, getting more money and giving out loans again. Don't you think that we would come to a point where we run out of all these people with great credit scores? That is exactly what happened, and this is where banks started lying, and that's what led to the 2008 financial crisis. And now you might be wondering, amidst all of this, why did the stock market crash in 2008? For that, you would have to understand what a credit default swap is. Now here's the thing, a short recap. The bank was giving out loans, then the bank was selling these loans to the investment bank, and the investment bank was selling these loans to investors. So now let's say the loans started defaulting, the investors would make losses, right? And they realized that there was even more money to be made in this process by selling a credit default swap. Now a credit default swap basically works as insurance on any particular loan-based product. Now for a second, just think logically like a human being. Let's say there aren't enough people with great credit scores to give out loans to, but the bank has a solution where it could just give a loan to anyone and sell that loan off to an investment bank. Wouldn't the bank give out loans to literally any person on the street? That is exactly what happened, where banks out of greed started lying about the quality of their loans. Banks started giving out loans to people who had no credit history, people who had no income. Banks sometimes didn't even bother to verify if their address is even real. The bank started inflating the appraisals in order to lower their loan to value ratio. Which means, let's say you have a house of 1 crore rupees on which you are trying to get a mortgage. Now the bank would at the most finance 80 lakh rupees for this. And many banks have to mandatorily maintain this loan to value ratio. Now if the bank says that your house is worth 2 crore rupees, then what do you think becomes of the loan to value ratio? Which is what started happening in the US, where the banks were outright lying about the value of the houses on which home loans were being given out. Let me tell you something about the best case scenario. Let's say there are a bunch of home loans with the best credit quality. Even these home loans would default at approximately a 10 to 20% rate, which means 10 to 20% of the borrowers might not be able to make the repayments for any reason. Now just for a second, imagine what would be this number for all the people who have been given loans without any verification. But you should also look at the housing environment in the US at that time. Because home loans were so easily accessible, because every single person was buying a house, everyone was getting loans and financing was cheap, the prices of houses were skyrocketing. And when I say skyrocketing, I'm not kidding. Look at this. Just like we have the Nifty in India that tells us about the performance of the broad stock market, there's an index in the US specifically for houses. This is called the Case-Shiller Real Home Price Index. Look at how it jumped in the periods between 2005 and 2008. So when the banks saw home prices rise so rapidly, they were even more comfortable. Why? Because there could be an infinite loop even if a borrower defaults. And there was something even more interesting happening at that time, which was called a strategic default. And now strategic default in the US is a big deal because the home loans that are given out there are called non-recourse loan, which means if the bank isn't able to recover all of its money after selling your house, they cannot come after you. Let's say you have some other assets like a car, some gold, the bank cannot legally claim that. This is not true for India because here all the loans that we have are recourse loans. Now here's something even more terrible. You might say that the US has traditionally been a significantly efficient market, which means that investors have easy information to the assets that they invest in. So in case any investor wanted to do some basic due diligence, they could easily find out that who were these home loans, but that didn't happen because of this one other entity, a credit rating agency who was doing something called rating shopping. Now a credit rating agency is a body that assigns a rating to any loan or any entity. The credit rating agency basically tells you that hey, if there is this organization that has a bunch of loans that it has taken out, then they can very likely repay them. Or it looks really bad and they can't repay them. Just like you and I have a credit score, if someone has a credit score of 800, we put them in the high credit quality category. And on the other hand, if someone has a credit score of let's say 600, then we say that this person might not be able to repay his loans. Similarly, in the context of credit ratings, if a bond is rated AAA, it meant that it was of the highest credit quality. On the other hand, if it was rated C, it meant that it's very close to default. So now this is what the investment banks would do. They would call these credit rating agencies and tell them that if we were to have all these home loans rated by you, what rating would you assign them? Picture this. You were sitting for a very big exam such as the UPSC or NEET, and the government says that you can pick your question paper examiner. It would be an entirely free market where you are free to pay that examiner whatever you like. So what would that lead to? Don't you think these examiners would say that, hey, you know what? Give me 10,000 rupees and I'll make sure that you get a perfect score. That's exactly what was happening with the credit rating agencies and the investment banks. All of these loans were of really poor credit quality, but all of those investment banks were rating them AAA or even better AAA plus. Now picture this, you have a home loan worth 1 crore rupees that I gave to you. Now I think that you are very unlikely to repay this loan. So what do? So now I go to a third party, maybe another bank, and I tell them that look, I gave out a loan to this person and I think that they are not likely to repay. So what do? So this bank sits me down and tells me that look, we have this exciting new product for you called a credit default swap. It's simple. You pay us a premium and if this person defaults on your loan and if you don't get your money back, then we'll make sure that we give it to you. Now here's what's exactly broken about the system. Any bank could go out and buy any number of credit default swaps from anyone on any particular loan product. That's like going to your neighbor and getting damage insurance on his car because you think that he's going to crash it tomorrow. Or going and telling your best friend that you just purchased 10 crore rupees worth of life insurance on their life and if they die, you would get 10 crore rupees. In the real world, for common people like you and me, this doesn't work. If we want to buy insurance, the insurance company would require us to prove something called an insurable interest. Which means if I'm buying damage insurance on my car, then that means I have insurable interest there. That is my car. That car takes me to office every single day. The insurance company won't allow me to buy insurance on my friend's car. So this is what all the major investment banks and financial corporations started doing. They started selling credit default swaps on these very loans that were of terrible credit quality. What did that mean? They were selling protection, they were selling insurance that in case these loans failed, in case these people defaulted on their home loans, then these banks would make payments. The only assumption was that no one would default because home prices were rising. So the banks kept on selling this CDS, getting the premium income and hoping that these loans don't default. And they were very comfortable because home prices were rising. One such company that sold a number of CDS contracts was Lehman Brothers. What happened with Lehman Brothers was scary. Lehman Brothers was a company that had $680 billion of exposure and only $22.5 billion of their own money, which meant that the company had exposure to the real estate sector worth $680 billion. Of which their own money was just $22.5 billion. So this is what would happen. $680 billion is almost 30 times of the money that Lehman Brothers actually had. So let's say the real estate values declined by 3%, then that would mean that the entire $680 billion would decline by 3%, which is about $21 billion. And now of this $680 billion, Lehman Brothers only owned $22 billion. So a 3% decline in real estate values would mean that Lehman Brothers' capital would be wiped out 99%. Lehman Brothers was a company that moved into loan origination in 1997. This was a time where they realized that mortgage-backed securities was a great way to make quick money. And you wouldn't believe this, by 2003 it was the third largest company in terms of lending and they had made $18.2 billion in loans. Lehman was doing everything. They owned banks that were originating loans, they had investment operations, they sold these loans to other people, they also sold a lot of CDS contracts on these loans. In short, Lehman Brothers was a company with a lot of exposure to the real estate sector which was growing up to become a bubble. So what happened when the bubble burst? Obviously, Lehman Brothers collapsed. But before this, you should realize something even more shocking had happened. There was a time when the Merrill Group and the Citi Group reported huge losses worth billions of dollars. You should realize that this was a period where people were starting to understand that the real estate sector is in a bubble. Many investors were starting to sell all their bonds. Company stock prices along with bond prices were in a free fall, and in such a period, Lehman Brothers reported a profit in spite of being one of the most over-leveraged companies. This happened because of something called accounting creativity. In simple words, fraud. Lehman Brothers started to misrepresent key facts on their balance sheet. They started misrepresenting repurchase agreements as outright sales. What does this mean in simple words? A repurchase agreement is a way of borrowing money. Let's say I have an asset like this watch and I sell it to you for 10,000 rupees. And you and I enter into an agreement where after 1 year, I would buy this watch back for 11,000 rupees. This doesn't mean that I have sold this watch to you. Instead, this means that I have just borrowed some money from you. But since this borrowing process involves a buy and sell transaction, we call this a repurchase agreement. Lehman Brothers started reporting these agreements as outright sales. They had a lot of junk assets on their balance sheets and they showed the investors that we've sold all of them. We got rid of them. There's nothing to worry. However, you couldn't do this forever and eventually it all went downhill. Lehman had to sell assets worth $6 billion and they reported a net loss of $2.8 billion in the immediate next quarter. Eventually, after being unable to find a buyer for the entire company that had now failed, Lehman declared bankruptcy. And when this happened, it all went downhill. The markets were in a free fall. You could see people leaving the headquarters of Lehman Brothers in New York all morning. On that day, about 25,000 jobs were lost. Between September and December 2008, according to the Bureau of Labor Statistics in the US, 18.97 million jobs were lost. This is more than the population of the entire city of Mumbai back then. Now you might also wonder, why did the markets in India crash if this happened in the US? Because of how globalized the US is as a country. The United States is a country that trades with literally everyone in the world, and the trade between India and US is huge. You would see a lot of engineering companies that have operations in the US. You would see a lot of banks that work in the US which have subsidiaries and branches in India. You would see a lot of trade happening between the small businesses of these countries as well, which is why there is high correlation between the US and the Indian stock market. And that is exactly how 2008 unfolded in the most oversimplified manner. If you found this video valuable, do subscribe to Personal Finance TV. It's free for you, but it keeps the entire team extremely motivated. I'll see you in the next one.